Okay, it looks as though people are filing in. Good afternoon, and welcome to Sensible Financial Planning's webinar on TIPS ladders. I'm Carrie Fristow, and I'll be the moderator today. Sensible Financial's founder, Rick Miller, today will talk about TIPS ladders. TIPS are Treasury Inflation-Protected Securities, and the term ladders refers to a specific way to buy TIPS and add them to your portfolio. Rick Miller holds a PhD in economics from the University of Chicago and started Sensible Financial over 20 years ago. He's also a certified financial planner. You can see all of our past webinars on Sensible Financial's website at sensiblefinancial.com/webinars. You can also register for upcoming webinars through a link in Sensible Financial's newsletter, which will come out later today, or at sensiblefinancial.com/webinars. There will be two Q&A sessions, one approximately midway through the webinar and one at the end. So please submit your questions through the Q&A link that's at the bottom of your screen. Rick will answer as many questions as he has time for, but he can't give personal advice in this setting. There just isn't the time for him to gather the information or context necessary to do so. At the end of the webinar, we'll display Rick's contact information in case you have more questions. Now, Rick will begin today's presentation.
Thank you, Carrie, and welcome everyone. Today, we are going to speak about TIPS ladders, and let's jump right into it. We're going to start by thinking about retirement income, and many people want safe income in retirement. We're going to talk today about what safe means. We'll look at some examples of safe income. We'll talk about threats to retirement income safety. And we'll talk about how, finally, a TIPS ladder can contribute to retirement income safety, can provide a source of cash flow that's predictable and safe. When you think of income, you probably expect it to be safe. Salaries are safe, Social Security is safe, but what do we mean by safe? And I'm going to suggest that there are three attributes that contribute to safety. One is that it's reliable, that you can count on it, that it is there when you expect it to be there. Secondly, that it's predictable, that it will be what you expect it to be when it arrives reliably. And finally, that it will be stable, that it's not jumping up and down in ways that might make you nervous. And specifically, we don't expect safe income to stop or to decline. So if we think about people that are of working age, we can distinguish between salaries, which I think most people would think of as safe and predictable, and bonuses, which are not predictable. Bonuses are high if things go well and not so high if things don't go well. But salaries persist and progress steadily. What options do we have for safe income in retirement? Perhaps the classic example is Social Security. It's definitely regular, it arrives every month, it's definitely predictable, and it's also resilient to economic shocks. And in particular, it's inflation adjusted, so that if inflation rises, your Social Security benefits will rise also. There are also pensions. Pensions are much less common now than they were several decades ago, but many companies still offer pensions, and those are income. Pensions provide income that arrives each month and is predictable in that way. Most pensions are not inflation protected, however. We could have income from our savings, income annuities, which are something like pensions, dividends from stocks and interest from bonds and savings accounts. And we can also use the principal of our savings. We have a built-in aversion to doing this because we spent our whole lives building up our savings, and we feel that we should keep them somehow for some reason. But many financial advisors, and Sensible Financial is one of them, suggest that you should think carefully about the possibility of using your principal because it can help provide spending power during retirement. Today, we're going to focus on bonds as a source of income and cash flow. Cash flow is if we think about cash flow consists both of income, so bonds pay dividends or interest, and also using principal because we can use that as cash. We can use it as spending power. And when we think about bonds today, we're going to think about both bond mutual funds, which are a way to hold bonds very efficiently, and also individual bonds. And I've called them here dedicated bonds to be spent. And in fact, that's what we're going to focus on today, bond mutual funds and dedicated bonds. So let's illustrate what we mean by safe income. Suppose that we have a retiree, and later I'm going to introduce the retiree as Jordan, but we can look at Jordan's plan here. Jordan is planning to spend about $140,000 a year. And Jordan has access to Social Security benefits here and to bonds here. And you'll notice that spending is stable and income from Social Security is stable and predictable, and income from bonds is stable and predictable. And there's a gap between this predictable income or cash flow and the amount of money that Jordan wants to spend. And that gap typically is filled by retirees with resources from their portfolio. And the portfolio typically contains stocks as well as bonds, and that makes it pretty unpredictable and pretty risky. So we're going to not think about the risky part today. We're going to focus on the safe. So let's talk a little bit more about bonds. Bonds are loans. The issuer or the borrower promises to pay interest, to pay back the principal, and they promise to do that when the interest is due and when the principal is due. So if they keep their promises, the cash flow is predictable. And the lender, the buyer of the bonds, can rely on those promises because it's a promise after all. And also, bad things happen to borrowers who break promises. And borrowers don't want those bad things to happen. And we've shown some of the bad things that can happen to borrowers when they don't pay interest and pay back the principal when it's due. When we're thinking about bonds, there are a few concepts that apply to just about every bond. And this picture, this is a real bond, but don't take a picture or a screenshot and try to cash it though, because it matured about 30 years ago. So therefore, I assure you that no one will give you cash for it, no matter what your skills at making duplicates of what's shown on the screen. So as we said before, bonds are loans, and the face amount here is the amount that the lender gives to the borrower when receiving the bond. The issuer is the borrower. And in this case, the borrower is the good old US of A. And the coupon is the interest rate. And since the face amount is $10,000 and the coupon is 10.125%, the interest payments are going to be 10.125% or 10 and an eighth of percent of 1,000, and that's 1,012.50 a year. Now, we haven't seen Treasury bonds with 10% interest rates for quite a while, but this is an example of one that did exist. The issue date when the loan was made is October 18th of 79, and the maturity date is when the loan is due, and that was in 1994. So this was a 15-year bond. When we think about holding bonds, there are, broadly speaking, two ways of doing it. One is in a mutual fund, and mutual funds have a lot of advantages. Mutual funds are an inexpensive way to hold bonds. Uh, they're an inexpensive way to hold stocks as well, and the benefits that apply to mutual funds, stock mutual funds, also apply to bond mutual funds. So they're inexpensive. It's easy to diversify. That is to hold lots and lots of stocks or lots and lots of bonds uh, without doing a lot of transactions yourself. And they're easy to buy and sell. The market for mutual funds is very liquid. And if you decided that you wanted to sell, if you had a mutual fund and you wanted to sell it today, you could sell it today and get the market price. So it's, you know what you have with the mutual fund. When you hold a bond mutual fund, you hold many different bonds from many different issuers, so from many different borrowers, and of many different maturities. That is, some bonds will mature this year, some will mature many years from now. And we're going to build an example that we're going to use in this webinar. So we're going to have just one kind of bond, and all of the bonds will have 30-year maturities. So we won't have any 5-year or 10-year bonds. They're all going to be 30-year maturities. And if interest rates change, they're going to change once a year. And that's a simplifying assumption that allows us to do some math and show the implications of changes in interest rates and changes in inflation. And finally, we're going to use bananas as a metaphor for the maturity of a bond. The ripe bananas, the ones that are ready right now, will have the shortest remaining maturity. And the greenest bananas, so here's the ripe bananas, and here's a green banana. So the ripe banana is going to mature this year. Is an example of a bond that's going to mature this year. And the green banana, we could think of as a bond that's going to mature in 30 years. And we don't have 30 different shades of bananas, and we're not going to show 30 bananas to show the different remaining amounts of maturity in our 30-year bonds. But you can imagine that the bond fund is going to hold bonds with a 30-year maturity, and then a bond that was issued 29 years ago is going to have 1 year of remaining maturity. A bond that was issued 27 years ago will have 3 years of remaining maturity, and so on. Okay, so now let's think a little bit more about Jordan. Jordan is 70 years old when they retire, and they're expecting to live to be 100, and so they have to have resources for all of the years between 70 and 100, and they're going to spend the same amount each year. And their retirement income resources, as we said a little bit earlier, they've got Social Security benefits of $40,000 a year, and they've got a bond mutual fund that's going to cover $60,000 a year, and then a portfolio that's going to cover the gap. Again, I'm going to not say anything else about that. Now, Jordan has, in this table here, we're looking at how Jordan is going to draw $60,000 a year from the mutual fund that Jordan owns. And in the first year, when Jordan is 70, they're going to get $26,876 in interest from all the bonds that they hold, all the bond funds that they hold, and then they're going to sell $33,000 worth of the bond fund. And the next year, or sorry, 5 years from now, interest will be somewhat lower, sales will be higher. And by the time Jordan reaches 99, the interest is very little, and they're going to get almost all of their cash flow from selling the fund. And we could see the same thing here in this picture. This is a picture of the same numbers, just for bonds though. And you see that the interest payments, which are in orange, are declining over time. And the amount from fund sales is going up over time. So here it's low, here it's high. And if Jordan had individual bonds, and individual bonds are used in a TIPS ladder, the pattern is going to be the same. That is to say that interest will be a large component of the total cash flow early on, and maturing bonds will be a high proportion at the end of retirement, lower at the beginning of retirement. So let's look at some bananas now and see what that looks like. So here is a bond ladder, and we're looking, this is now Jordan in the middle of retirement. So you see that Jordan is 85, and I'm showing 5 bonds to stand for the 15 bonds that remain. And here we've got the ones that are going to mature this year, and these are the ones that are going to mature toward the end of retirement. And this year at 85, all of the bonds that mature at Jordan's age 85 will mature. And then Jordan will have left the bonds that mature after age 85 and up to age 99. And then as time goes on, let's say Jordan is 90, the bonds that mature at age 90 will mature. And Jordan will spend the proceeds from that as well as the interest from all of the remaining bonds. And then Jordan will have only a few more bonds left. A few more, will have lots of bonds, but only a few more maturities. And notice that Jordan's ladder has no bonds that mature after age 100. There's no bonds out here. Each year, Jordan has fewer bond maturities, and each of the newest bonds gets 1 year closer to maturity. So you notice that the bond at age 92, I'm showing at age 92 here, is now mature. But if we'd looked at it in the first case, it would have been this color. So less mature. All right, now let's look at the situation if Jordan had a bond fund. Here's the bond fund. Now, Jordan holds all these bananas, all these maturities, and it looks like the same thing. But now, when Jordan goes to get cash flow from maturing bonds and sells bond fund, Jordan is going to sell all of the bananas or all of the bonds in the fund, because when you sell a bond fund, you have to sell shares in the bond fund, and shares in the bond fund represent every bond in the fund. So Jordan's going to be selling mature bonds and bonds that are going to mature a long time from now. And then as time goes on, the fund is going to have the same number of bonds, the same number of maturities of bonds. And some of them are going to mature after age 100, which is different from the ladder. And again, at this age, Jordan is going to sell the whole fund, shares in the whole fund, and therefore bonds of all maturities. And when Jordan gets to the end of retirement, a lot of the bonds in the fund, almost all of them, will be maturing after the end of her retirement. Okay. All right. Terry, we can take questions now if we have them. I don't know if we do. Go ahead.
We do,
Okay.
yeah. So Carl asks, well, he mentions, he says, when I've looked at tips, even today, the rates were not super appealing. CDs were paying nearly double the
Right.
tips rates. So
Right.
what is the advantage of tips over other safe investments like CDs?
Okay. So we'll talk about that more in the next section. But basically, I suspect that Carl is looking at the TIPS real rate of return and the CD's nominal rate of return. And the TIPS return includes both its real rate and the inflation rate. So the TIPS nominal return, the total return on TIPS, is the coupon, which is right now 2.5% plus inflation, which is of the order of 2.5 or 3%. So we get to 5.5 or so on tips in total, which is comparable to what you can get in CDs.
Okay.
I'd say just a little bit more. The market for cash flows and for income is with bonds is competitive, and so bond prices adjust so that the returns on bonds of various maturities and with various um, uh, face coupons, various face interest rates, the prices change so that the uh, earned return rates of return are pretty much all the same across all of the instruments. So bonds of different maturities and bonds of different types, like tips and standard treasury bonds.
Okay. Aaron asks about ETFs, bond ETFs.
Yeah.
Um,
What does Aaron ask about bond ETFs?
he just says, how about them?
How about those ETFs? Um, ETFs are actually a type of mutual fund, and um, uh, or most ETFs are. There are some technical differences for some, uh, but fundamentally, ETFs are doing the same thing. They're holding bonds of multiple maturities and from multiple issuers, and they're providing inexpensive access to bonds. Unlike mutual funds, they trade throughout the day. So, and traditional mutual funds trade only after the market closes. So there are technical advantages to ETFs for some purposes, and technical advantages to traditional mutual funds for other purposes. Uh, it, it, at the first order, or thinking about it at the first order level, they're just about equivalent. So when I say mutual funds, you can think ETFs, and you're not going to be far off.
Okay. Phil wants to know, does it ever make sense to have tips in a taxable account?
Really good question. And the short answer is yes. I will say that is really beyond the scope of this webinar. And we did a webinar on tips. We've done a couple of webinars on tips. The first one that we did covered that question in a lot of detail. So when we send out an email to all of the participants in today's webinar, we'll include a link to that one. That is a complicated question, and people disagree. But my answer is yes, it does make sense to hold tips in taxable accounts. The first, in general, one would rather hold bonds in retirement accounts than in taxable accounts. But if your retirement accounts are full of bonds and you want to hold more bonds, then holding them in a taxable account is just fine. And so let me stop there.
Okay. Someone else asks, since tips are at a high historical level, is there a downside to having your entire investment fund in tips and capture the real return of 2% plus for the next 3 years?
We're not recommending, I'm not recommending that you put all of your investment funds in tips. Someone once said, all things in moderation. And I think that tips are a very useful component of a portfolio, and we'll talk about how to structure that to get certain benefits. But I would never say, I shouldn't say never, because you never say never. But in general, I would not be advising people to take their whole portfolio and put them in tips or in a tips ladder. Okay, so Carrie, I think we should move on here. I don't want to run out of time. The next part is a little dense or denser. So I'd like to proceed.
Sure. There, people who still have questions, you can keep adding the questions because Rick's going to answer more at the end. Okay, thanks.
Okay, so even if funding is safe, it may not turn out quite the way we expect. Bonds and bond funds that hold bonds and the bond funds that hold them are subject to market forces. Interest rates can rise, and we'll see how those affect bond prices. Inflation can increase, and that can also influence the purchasing power of Jordan's bonds. Social Security retirement benefits don't change when interest rates change, and they increase to keep pace with inflation. So they are just about the safest source of retirement cash flow there is. There is nothing is risk-free. There is a risk that the U.S. government will break its promise to pay Social Security benefits, but in our judgment right now is that that is a smaller risk than interest rate increases and inflation increases. Okay, so the first concept that we want to talk about in this section is that when interest rates rise, bond prices fall. And we're going to introduce something called a zero coupon bond as the easiest way to see this. Zero coupon bonds make no explicit interest payments. So they pay a fixed amount when the bond matures, but there's no interest payment between purchase and maturity. So you buy something today, and you buy a zero coupon bond today, and in 10 years, let's say you're going to get $1,000. So the only thing that can vary, since there's no coupon on these bonds, the only thing that can vary is how much you pay for the bond today. And how much you pay for the bond today depends on the interest rate. If the interest rate is 1%, you pay $905 for a bond that will pay you $1,000 in 10 years. If the interest rate is 5%, you'll pay only $614. So the price today, this bond price is this set of bond prices, and they produce this $1,000 return in 10 years. Now, suppose that we had just bought a bond with an interest rate of 1%, and we paid $905 for it. And tomorrow, interest rates rise to 5%. Well, now those bonds that pay $1,000 in 10 years cost only $614. And if we go to sell our bond that we paid $905 for, we'll see that we won't be able to do it. No one will buy it. They'll only pay $614 for a bond that is going to pay $1,000 in 10 years. So this illustrates that when interest rates rise, bond prices fall. And the effect is greater for longer maturities. With longer maturity bonds, there's more time for higher interest rates to work. And so we're seeing here now, here's the 10-year bonds. You see these are the same numbers that we saw in the previous slide, right? For 1%, $905, 5%, $614. But if we look at a 20-year bond, the price difference is much bigger between 1% and 5% than it is for 10-year bonds. And that, again, is because the interest rate has a longer time to work. So, but the same principle applies. Interest rates rise, bond prices fall, but the longer the maturity is, for a given rise in interest rates, the more the bond prices will fall. Now let's think about the bond fund investors who are expecting stable prices in their bonds. And let's think about Jordan again. So Jordan's been living in a world with 2% interest rates. If interest rates have been stable, all the bonds that Jordan sees will be worth $1,000. And they're all going to have 2% coupons. And Jordan's mutual fund holds one bond of each maturity. So it holds 30 bonds from remaining maturities of 1, 2, 3, all the way up to 30. And the fund is going to be $30,000 a share because each bond matures at $1,000, and each bond trades at $1,000 throughout the Jordan's retirement. Now, if interest rates rise to 4%, then those bond prices are going to fall. It's not for this year. If Jordan's 85, the bonds that are maturing at Jordan's age 85 are going to mature at $1,000. That's what it says on the face, and that's what the borrower is going to pay back. But the bonds that mature further out are going to have lower prices. They're going to trade at lower prices. And Jordan, at age 85, is selling a lot of shares of their bond fund. And instead of $30,000, they're going to get only about $24,000. That's very disappointing. That's a change in price of the bond fund of about 20%. And that turns out to mean that the total cash flow for Jordan is going to decline about 9%. Total income is going to decrease about 5%, and Jordan's going to have to cut back. So Jordan's plan does not protect them against rising interest rates. And Jordan's plan, by Jordan's plan, I mean buying a bond fund and expecting to sell it a certain amount each year. And the amount that Jordan is going to get when they sell them each year is going to be lower if interest rates have risen. And that's what happened in 2022. You may remember that interest rates rose and bond prices fell, and bond mutual fund prices fell. There's also inflation as a risk. And you've certainly noticed that your money buys less than it used to, say, 2 or 3 years ago, but you may not have noticed, because it happened more slowly, that your money buys less than it did in 2003. And it's fallen by about 40%. The purchasing power of the dollar has fallen by about 40% since 2003, and by about a quarter, a little less than a quarter, since 2013. That's a big decline in purchasing power. And we've got to remember that traditional bonds, nominal bonds, are denominated in dollars. And therefore, a 10-year bond at 2% inflation, the dollars that we paid for the bond today are going to be worth more than the bonds that we're going to get 10 years from now when the bond matures, if it's a 10-year bond, or less than the bond is worth 30 years from now if we bought a 30-year bond. Okay, now this is this is a direct explanation or a direct response to the first question that we had, which is how do real interest rates, nominal interest rates, and inflation relate? And the very simple answer is you start with a real interest rate. In this example, it's 3%. You add the inflation rate of 2%, and you get the nominal interest rate of 5%. So in the market today, if inflation is expected to be, let's say, 2.5%, and real interest rates are 2.5%, then TIPS are going to offer 2.5% coupons, and they're real interest coupons, and nominal bonds are going to have 5% coupons. And people will be indifferent between buying nominal bonds and TIPS as long as they expect inflation to continue to be steady at 2.5%. Okay. And I would emphasize that for the purposes of thinking about purchasing power, the interest rates that matter are the real interest rates, not the nominal interest rates, because the real interest rates are the ones that, if we're getting a real interest rate of 3%, that means that our purchasing power is going up by 3% each year. And if we've got, let's say, in this example, I'm sorry, I've changed the numbers back and forth between 2.5% inflation and 2% inflation. Let's stay with this example. If I have a nominal bond that's paying 5% and inflation is 2%, then my purchasing power return is only 3%. Even though I might think, well, I'm getting 5%, I have to subtract inflation to find out what I'm really getting in terms of what I can buy. Okay, so An inflation rise is going to disappoint bond fund holders too. In Jordan's world, real interest rates have been 2%, inflation's been 0. Suppose that inflation rises to 2%. Then the nominal interest rate's going to increase to 4%. And just as it did before, or just as they did before, bond prices will fall. The interest rate went from 2% to 4%, and the bond prices fell exactly in the same way. And again, it's worth about $24,000. The bond fund price is about $24,000 after this increase in inflation. There's more though, because, and I'm sorry, the price change is the same, but inflation is a double whammy because it raises the nominal interest rate and nominal bond fund prices fall. And then it's also the case that the purchasing power of those lower nominal prices is still lower because of inflation. So the mutual fund price will fall the same amount as it did before, but a rise in inflation is worse than a rise in real interest rates for bonds because that lower mutual fund price and those lower bond prices are even lower in purchasing power terms. So now Jordan's really going to have to cut back because with that increase of 2% in inflation and the nominal rate increase of 2%, bond income or cash flow is now down 20%. And the total decrease in cash flow is 12%. So that's just about twice the loss that we saw before. Both real interest rate increases and inflation increases reduce the value of bond fund cash flows. And the bonds and the bond funds that Jordan thought were safe turned out to be not so safe at all. TIPS can solve both of these problems. For TIPS, the interest rate is fixed in real terms, so it's unaffected by inflation. And let me talk just for a second about how TIPS work. TIPS are treasury bonds. The coupon is set in real terms. So let's suppose, let's use our example of a 3% return. And suppose the TIPS had a 3% coupon, and they were sort of trucking along paying 3%, and then inflation went from 0% to 2%. Then the face amount of the TIPS is going to go up by 2%. And so the total return is the coupon of 3%, the real interest rate, plus the change in the price of or the face amount of the TIPS of 2%. Total return 5%, 5% nominal. So the TIPS are going to continue to pay that 3% real return. And that's a lot to cover in detail here, so I'm not going to try. We've done a webinar called Tips for Beginners that talks about how TIPS works in much more detail. And we will send that to you, to all attendees at we'll send the link to that webinar to all attendees at this webinar. We can see a little bit more, in a little bit more detail though, how that works. So let's look at a traditional nominal bond. And with principal of $1,000, paying 2% interest. Suppose inflation is 2%. So that's going to reduce the purchasing power by 2%. That's a reduction in purchasing power. And then there's no inflation adjustment, so the buying power is $1,000. So the net return on this bond was 0. 1,000 plus 20 for interest minus 20 for inflation, that's just 1,000. With TIPS, you get, in addition to the 2% interest, you get an inflation adjustment to the face amount of $20. So you've got $20 of interest, $20 of inflation adjustment, that's $40 of return. Subtract the inflation theft, if you will, that leaves us with $20 of net return, and we end up with 1,020. So we got the 2% interest that we expected. TIPS mutual fund holders don't fear inflation, but rising interest rates, real interest rates, will still disappoint them. If Jordan holds TIPS in a mutual fund, when interest rates rise, the prices of those TIPS that mature after the current year are going to fall just the way they did for nominal bonds. And therefore, the fund price will fall and the impact is the same. So TIPS protect against inflation, but TIPS in a bond fund and a TIPS fund don't protect you against rising interest rates. So what do? There's two parts to this problem. The first is that when interest rates rise, the fund holds bonds that mature in the future, and those bond prices fall when the interest rates rise. And then the bond fund holder, when they sell the fund, has to sell all the bonds in the fund, because that's the way funds work. When you sell a share in the fund, you sell a share in every bond that the fund holds. And that includes the bonds whose prices have fallen. A TIPS ladder can't prevent the lower prices for the future maturing bonds or for the fund, but ladder holders can wait for the future maturing bonds to mature at the price they expect. And each TIPS in the ladder is going to mature at face value and won't be affected by interest rate increases. The TIPS will mature just when the TIPS ladder holder expects them to, and when they mature, you're going to get the full value. So here we go. Let's see what that looks like. So we have, I'm looking for here we go. Looking for my little pointer here, which I like. Okay. So you see that the TIPS the ladder holder doesn't hold any bonds out here that mature after the end of their retirement. But the bonds that they hold, suppose that they hold bonds that mature at their age 85 and at their age 90 and 95, the prices at their age 85 have fallen, but they're only going to take cash from the bonds that are maturing, and they're going to get the full 1,000 for that. And the same is true at their age 90, right? The bonds that are going to mature at their age 95 have lower prices, but the bonds that are maturing now are paying $1,000 as they mature. And so the TIPS ladder holder is not disappointed in any year. Now, the ladder holder might be concerned because they look out and they see that these prices have fallen. But if they stick it out, they're going to get exactly what they expected, exactly what they planned. So how do bond ladders protect planned cash flow? And we're comparing here ladders and funds. So the ladders hold bonds that mature as planned, whereas the mutual funds hold bonds of many maturities. They're not matching them to when they're planned to be spent. They hold no bonds that mature after planned spending. The funds hold bonds that mature long after planned spending. And ladders allow holders to use proceeds only from the maturing bonds, whereas mutual funds mean or require you to sell all the bonds, not just the bonds that mature this year. So TIPS ladders are the safest and most predictable bond-based cash flow you can have. And they work because they hold treasury bonds. Those are the lowest risk bonds. There's minimal credit risk. That's what we see out here. They have inflation protection because they're TIPS. Here. And they have interest rate protection because they're laddered. And nominal bond ladders have interest rate protection, but they don't have inflation protection. So TIPS ladders are the only approach that has all three of these advantageous characteristics. And Carrie, we can take a few more questions.
Okay. Yeah, we have some. We have some good ones. So here, okay. Here's one. Do bonds mature at death? In other words, can you pass a bond on to a loved one?
Yes, you can. Absolutely. Tips and bonds are securities like stocks or any other security. They're tradable and they're heritable.
Okay, okay. Um, Here's an interesting one. How important is it to buy tips for each year as opposed to larger volumes every 3 to 5 years, with an assumption that one can reinvest in uh, money market funds for 2 to 4 years at the current
Right.
interest rates?
Yeah.
Yeah.
Yeah. So um, the longer the gap between the tips, the more interest rate risk you're taking, right? Because
Okay.
you're taking interest rate risk for all the years that you don't have tips maturing. Um, it's a practical question, and um, uh, I think you can make any decision that you like. I mean, there are if you wanted to, you could buy tips that mature every quarter instead of every year. Some tips are available. It turns out the tips are available in 30-year maturities, 10-year maturities, and 5-year maturities. And those different maturities mature at different points in the year. So you could go nuts and do that. Um, I think that some laddering is going to be better than no laddering. And if you have the patience, it's not that much more difficult to buy tips that mature every year than it is to buy larger chunks that mature every 5 years, let's say.
Okay. Um, Someone asks, I know these are US Treasury bonds, but are these options available in Canada? Someone wanted to know.
Oh, good question. I know that they're available in some other countries. I don't know about Canada. We can find that out, and uh, if we can make a note, I will respond to that question.
Okay. Um, let's see. So here's a complicated question. I duration matched two TIPS funds to age 92
Yep,
using long-term fund and intermediate term funds
right.
back in 2020.
Yep,
My long fund is now getting clobbered in value.
yep.
If I hold both funds until the duration and spend down the prescribed amount, will I lose money?
Oh, that's a really complicated question,
It
and it
is.
depends on what happens to interest rates between now and then. Um, but I'm sad to say that it illustrates the difficulties that are associated with funds.
Mhm.
Maturity matching of the funds is better than holding just one or just the other, but it still subjects you to interest rate risk. Um, and uh, knowing what to do now is, I think that's depends on the specifics. I think you'd have to do an analysis to and think it all the way through, I'm afraid.
Right. Okay. So Aaron says, if I'm understanding this correctly, I should buy bonds when interest rates are high.
Yeah, it would be great to do that. Um, but the problem is you may end up waiting, and interest rates might fall. You might wait a long time. So that's sort of like saying, well, I should buy stocks when the prices are low. This is my favorite uh, line, right? How to make money in stocks. And I'm not going to give you the name of the fellow because I can't remember, but it'll come to me. Will Rogers. Um, so, how to make money in stocks? You buy a good stock, and when it goes up, sell it. And if it doesn't go up, don't buy it. Um, so it's kind of the same thing with interest rates, right? I mean, how do you buy bonds that are going to give you a great return? Well, you buy a bond with a really good interest rate and you hold it until it matures. And if it doesn't have a really good interest rate, don't buy it. But that's not really practical advice. Um, you could say that you're going to um, sort of dollar cost average into your tips ladder, and you could buy some bonds now and some bonds later. Um, if you had done that, say starting 10 years ago, you would have bought a lot of tips that had zero real rate of return. Um, but that would have been the best you could do at the time, and it would have protected you against the changes in tips prices that occurred in 2022 when interest rates rose and TIPS fund prices dropped sharply, and as did other bond fund prices.
Okay, Chris wants to know if I have a TIPS ladder, is there any value in also having other fixed income instruments like ETFs, or can the ladder be your entire fixed income category for asset allocation purposes?
That's a really good question, and I think it depends again on your overall approach and on the amount of income that you need, the amount of cash flow that you need, and the amount of risk that you're willing to take for the part of your cash flow that is not inflation protected and maturity matched, right? So if we think about what we're doing here more broadly, it's called asset liability matching, and we're matching Social Security benefits to spending, and we know how much Social Security benefit we're going to get each year. We know how much we plan to spend each year, and there's usually a gap, often a gap between what you're planning to get in Social Security or expecting to get in Social Security benefits and what you need or want to spend in a year. So you can say, well, let me fill some of that gap with with let's say TIPS ladders, and now I've got a smaller gap remaining, but it's still a gap. And then the question is, how much risk are you willing to take at filling that gap? And if you're willing to take stock risk for that gap, then you can hold all stocks and no bonds. But if that's more risk than you're willing to take with the remaining gap, then you want to hold a portfolio that has bonds and stocks in it.
Okay. Oh, here's a question of implementation. Would you buy ladders for the next few years and then keep adding, or do you buy the ladder all at once? Can you do that?
You can do either. And this is similar to the question we had earlier, which was, shouldn't I wait until interest rates are high and then buy my ladder? I have another favorite line, which is that, and Carrie's heard all of these 50 times, so I beg your indulgence, Carrie. If I knew what interest rates were going to be next year, I wouldn't be doing this webinar, and certainly not from here. I'd be doing this webinar if I were doing it from my private island in the Hawaiian chain. Because if you can predict interest rates, you can mint money. But people can't do that. The people who you would think would know lots about interest rates, Janet Yellen, for example, the U.S. Treasurer, or Secretary of the Treasury, or Jerome Powell, who's the head of the Fed. You'd think they'd know what the interest rates are going to be, but they've been surprised. And if they've been surprised, then it's pretty hard for those of us who are mere mortals not to be surprised. So you could look at things two ways. You could say, well, real interest rates now are higher than they've been in decades, and therefore I want to lock them in. Or you could say they're high now, but I think they're going to be higher, so I'll buy some now and wait and hold some later, buy some later, and then you're taking interest rate risk, uh, more interest rate risk, and uh, that unfortunately I can't help you there. All I can do is to say, relative to other ways of financing cash flow in retirement, a TIPS ladder now has lower risk than other types of bond investments now. But I can't tell you how to buy the TIPS ladder. Let's say, suppose you're 65 now, and you're trying to figure out when to buy the TIPS ladder. I can't tell you when you'll get the best total return between now and, let's say, age 70. I just don't know how to do that, and I'm afraid nobody does.
So here's a couple that I think are sort of quicker. Are TIPS and ETFs federally tax exempt?
ETFs, no. TIPS, no.
It
They
was
are
quick.
state tax exempt. The interest on TIPS is state tax exempt.
Okay. If you have a TIPS ladder held in an IRA, how can you handle the RMDs?
Good question. Uh, the way that we do it is to estimate what the RMDs are likely to be, and you can do that using the size of the IRA and the uniform life table that the IRS puts out, and then you buy TIPS so that the maturing TIPS plus the interest will pretty close to match the RMD in the IRA. And if you're married and you have two IRAs, then you have two RMDs, and if you can do the same thing in both IRAs. But the answers are going to be different because the IRAs are going to be of different sizes, and the ages of the owners of the IRAs may also be slightly different.
Mhm. I just want to, oh, there was another one that was good. Ah, I had a good one. I can find it. Well, here's another implementation question. I mean, how do you buy them just in general? I mean, where do you go to buy TIPS as an individual?
Okay, so there are several places. If you're buying, if you want to buy TIPS at auction, meaning when they're issued, then you can buy them on a U.S. government website called TreasuryDirect.gov. You can buy them at auction at a bank. You can buy them at auction in a brokerage account. If you want to buy bonds, TIPS on the secondary market, meaning after they've been issued, then a brokerage account is probably the best place.
Okay.
And you can have IRA, you can have a brokerage account in your IRA. And Carrie, I think that we should wrap up here. We're getting close to time.
Right. Right. I'll save these questions because there are still more, and
Okay.
And we'll send them to Rick, and we'll see if we can answer them, some of them at least, in the email that we send out to people who've registered for this.
Very good.
Okay. Great.
Okay, so let's conclude now. Okay, so what should you take away from today's webinar, besides a slice of this delicious looking banana cream pie? So the takeaways are, many people want safe income retirement in retirement. It's what they're used to. There's several options to choose among. Social Security is the safest one, but you can't buy more of it once you retire. Other safe choices face inflation and investment and interest rate risk. TIPS protect against inflation risk. Well-designed bond ladders protect against interest rate risk. And well-designed TIPS ladders protect against both inflation and interest rate risk. That concludes the webinar. I hope that you found it helpful. And if you need to get in touch, here is our contact information. Thanks for joining us, everyone. Have a great afternoon.